Hello, everyone. I hope you're having a great Friday. I am Robert with OpenLane Funding. Yesterday's personal consumption expenditures report changed the trajectory for mortgage rates this week, and we got a wave of housing data that tells a very specific story about where buyers stand right now. There is a lot to unpack, so let's get right into it. Let me start with the big economic story of the week. The personal consumption expenditures inflation report released yesterday morning. That is the Federal Reserve's preferred gauge. The new Governor Waller had estimated headline at approximately 3.8% and the core at around 3.3%. And the actual print came in right at those numbers. But here is the important detail. On the month over month basis, the headline rose 0.4% and the core rose only 0.2%. Both are 10 basis points below the consensus. The core PCE specifically was forecast at 0.3%, and it came in at 0.24%. So while the annual reading is the highest in 3 years, the monthly print actually landed on the cool side of expectations. And the bond market is taking notice of that. The 10-year Treasury eased to 4.45%, and that is down from 4.56% at the start of last week. Freddie Mac's, a weekly survey released yesterday, and it came in at 6.53%. Barely changed from the prior week, despite early week rate scares. NerdWallet's Friday morning average is 6.41%, and the bank rate is at 6.59%. The market got the relief that it was hoping for. It's a modest relief, but you know what? It's a real one. Here is the broader economic picture. First quarter gross domestic product grew 2%. The Atlanta Federal Reserve second quarter tracker is now 4.3% annualized. That is stronger nominal growth. But here's what is happening underneath. The real retail sales actually fell 0.2% in April. Consumers are losing purchasing power even as they spend more nominally. University of Michigan consumer sentiment hit 44.8% in the final May reading. That is the all-time record low since the survey began in 1952. That is worse than the 2008 financial crisis, worse than the 1980 recession, and it's 57% of their respondents cited that high prices are eroding their personal finances. Long-run inflation expectations are at 3.9%, and that's a 7-month high. Governor Waller specifically called this out in his Frankfurt speech as it is concerning to the Federal Reserve. The energy picture is shifting in a way that helps, though. West Texas Intermediate crude peaked at $102.68 on May 18th, and that is a 53% surge since the Iran conflict began. As of Friday morning, oil trading hit around $91 on incredible peace deal signals. And this is on track for a weekly loss. So every $5 sustained for the decline removes approximately 15 to 20% or 20 basis points on the inflation pressure over the next 3 to 6 months. Now, the peace deal is not confirmed, and the Iran nuclear program remains the central sticking point. However, the direction, it is favorable. The tariff situation adds another layer. The Federal Circuit Court of Appeals ruled the 10% Global International Emergency Economic Powers Act tariffs unlawful. And the administration is appealing to the Supreme Court, and the European Union still faces a July 4th deadline. The Institute of Supply Management Manufacturing Input Price Index at 84.6% is matching the 2022 pandemic supply chain peak. And that is the and that is a 2 to 3 month leading indicator for consumer pricing. The pipeline is still being loaded. Now, let me bring this into the housing market specifically. The April housing starts fell 2.8% month over month to 1.4 million units. Single family starts specifically dropped 9%, but building permits rose 5.8%, which is a forward-looking positive signal that the new construction pipeline is not collapsing. The March surge in starts was builder front running. The rate spike that the rate spike followed. When we got the new home sales report from the Consensus Bureau yesterday, and this one is significant, April new homes sales fell 6.2% month over month to 622,000 on a seasonally adjusted annualized rate. And they are down 11.3% year over year. The month supply of new homes jumped to 9.4 months, and that's the highest since 2022. Builders are sitting on a lot of unsold inventory. The existing home sales in April held at 4.2 or 4.02 million, essentially flat month over month, with 34 consecutive year-over-year median price gains at a 0.9% to $417,000. Existing inventory is also up to 1.47 million, also the highest since 2002 at 4.4 months of supply. Now, buyers have more options on both new and existing than they had in years. So the National Association of Realtors has their pending sales that came in as well, and it's at plus 1.4% month over month and plus 3.2% year over year. The fourth straight year over year gain. And that was the forward demand signal. But here is the key reversal that just dropped. Redfin's pending home sales for the week of May 2024 fell 1.5%, the second straight week decline. The median monthly mortgage payment hit $2,600, and that is at a 6.51% rate, the highest level in 11 months. Mortgage purchase applications fell to their lowest level since April. The rate run from 6.3% to 6.5% was enough to break the momentum that we saw in early May, building in early May. Days on market are also at 40 days. The share of the homes with the price drop is at 18.9%, and that is slightly down from 20% a year ago. The share selling above the list is at 27.5%. The investor framing remains exactly where I said it was last week. Modestly declining prices combined with rent steady equals the best cash flow conditions for disciplined acquisitions in approximately a decade. If you're buying right, this is actually the environment you want to be in. And Realtor.com is listing prices have declined year over year for 18 consecutive months. But the decline is narrowing from negative 2.9%. And that's 3 weeks ago from negative 2.3%. Sellers are pricing more realistically at the front end rather than cutting later. Even in our local market in Spokane, we are still, inventory and everything is up, right? But the prices, inventory, listing, sales, everything is up. But the prices itself per home is down, and it's on a deepening cut as well. So depending upon your local area, we can talk about how the market's shifting, and I can help you get a feasibility report that shows, okay, this is where I'm at. This is where I need to be for these properties. So here's your action plan going into next week. Step one, the cool PCE print brought us a window. Mortgage rates eased modestly, but the bond market is still pricing at a 40% probability of a Federal Reserve rate hike in December. The June 16th and 17th Federal Market Committee, the first under the new chair Warsh, is the next major catalyst. If you have a client ready to lock, the window of opportunity is right now. Step two, if you are looking at a bridge loan on a deal with a 12-month exit thesis, stress test your exit assumptions. I can help you with that, but you want to stress test these against a world where rates are at 25 to 50 basis points higher at your refi date. And that is with the hawkish Fed pivot is real even if the PCE cooled at the margin. Step three, the great stall is showing up in my data now again. Pending sales are declining 2 weeks in a row. Days on market are at 40. Sellers are cutting within 3 to 4 weeks. Make offers below ask on any property that has been sitting. Now's your time for negotiation. You need to use the data and not your emotions. Step four, new construction is your competition on the exit. For any Spokane fix and flip or nationwide fix and flip, and the builders are now sitting on 9.4 months of supply. That's the highest in 4 years. These builders are cutting prices, and they're going to keep cutting these prices. Your scale needs to be priced to compete with the new home that builders are increasingly motivated to move. On Monday, everybody, I'm going to do a deep dive in the Spokane and Coeur d'Alene. I'm going to give you guys a fresh data on the CDA that's all in. And June 1st is going to be, which is only 3 days away. If I can get all this out. Every Spokane landlord needs to be ready for the eviction diversion ordinance. I'll see you guys on Monday. I'm Robert with OpenLane Funding. Thank you guys.